consider the effect of the policies and conclude. It's pretty simple. You got two choices, just make up the choice. And then make sure you get audit committee buy-in, because this is something you need to worry about. Because if you make a choice without the audit committee, and the audit committee, March 31st, 2011 says, hey, I know this other company that's doing this, why aren't we doing it that way? If you've already done your books a certain way and you haven't got the audit committee to buy into what you're doing, you might have to go back and change your accounting policies, and it'll cause a lot of headaches. So up front, make sure you get the audit committee to buy into what you're doing. Now we'll actually get into some areas you care about. So mineral properties, at the top here, you can see that there's an IFRS and an IAS. The idea there, those are the sections that the mineral properties are affected by, the two sections. IFRS 6 is going to affect most of you guys. That's when you're in the exploration stages. Once you're getting into development, you're moving to IAS 16, which is also for property, plant, and equipment. So unlike Canadian GAAP, where mineral properties are handled under one section, you actually move throughout IFRS into IFRS 6 to IAS 16, and your impairment test is IAS 36. So it's not contained in one part of the handbook. And so the key point here, and this is in relation to IFRS 6, is there's a significant latitude in accounting policies for deferral and exploration of mineral properties. Essentially, you'll be able to use what you had before. You'll be able to carry forward that. The reason for that is when the EU converged in 2005, there was a lot of different mineral property companies that had quite a bit difference in the policies they used. And they said, well, we don't have enough time to get this right, so we'll let everybody keep on doing what they were doing before, is essentially what's happened. And they've been working on IFRS 6. They actually released a draft discussion paper, so it's not even at a discussion paper level. I think it was in October or September of this year. And they've been working on it for about 10 years, trying to get this IFRS 6 right and get it solid, because it includes all extractive industries and also includes oil and gas. But that standard isn't going to be ready for quite a while. Some people say 2011, that's very unlikely. Some people are saying 2013, and I think even that's unlikely. So we're locked into IFRS 6 right now. And the next point with that is, if you've got a significant latitude, you can capitalize our expense. So what you guys are doing now, you guys are going to be able to keep on doing. Don't worry about changing it up for IFRS. You can keep on going with the policy you have. And we don't have guidance right now to say that, hey, in 5, 6 years, or 10 years, when then you get the new IFRS 6 out, what's going to be the best method to use? I suggest just keep on going with what you're doing. Let's go to the next one. These are some small differences with IFRS and Canadian GAAP. Most of you guys, prior to obtaining a legal right to explore, are likely expensing your costs, but some people will defer them. They'll say, we're out in the field, we're looking at this, we don't have legal right to explore this yet, but we'll defer it and we'll include it in the cost base. Under IFRS, those costs would not be allowed to be deferred. Usually they're insignificant. I mean, $1,000, $10,000, not too big, not too important. So, but that is a difference. The one way that people are, I guess the interpretation of this, the way that's going is costs associated with obtaining the legal right can be deferred. So if you say, I need to go in and I need to get some geological data to determine if I want to get the legal right to explore, you could defer that, but it needs to be closely tied. You can't be very general. The example that I use, because it's common in the industry, is oil and gas. You'll take seismic and you'll blast a big area. So just set dynamite off and you'll blast a massive area to figure out where you're interested in going to explore. Well, if you find something that's interesting, you'll go in and blast some dynamite on top and see if you've got any oil and gas underneath. That directed blasting, the dynamite, you'd be okay with deferring that, but the more general one, you would not be able to. You'd have to expense it. So there's a requirement to separately disclose exploration and development costs. So this is where you go from your transition. you move from different sections in your handbook, your IFRS handbook, from IFRS 6 to IAS 16. IFRS 6, you're allowed to do what you're doing right now, in the sense of, I've got some mineral properties, I don't know what's underneath the ground, I'm deferring all my costs. Let's keep it all in the books until we decided to run away, or we know we've spent way too much and we think it's likely about $2 million to $3 million that property should be valued at. So that under IFRS 6 is very similar. Once you move to IAS 16, you're going to go into the impairment standard in terms of like how to determine whether or not you need to impair that asset. We're going to go into the impairment standard a bit later on, but that's again something a bit different. But one of the good parts about impairment is you can reverse it under IFRS. In Canadian GAAP, if you've impaired something, you're stuck with it. Under IFRS, if you come up with some evidence, you've gone into production on an asset you previously wrote off, you can go back up to your book value, to your costs, and recover those losses, put them on your books. Share capital. Really here, there's not a lot of differences for type of companies that we're dealing with compared to Canadian GAAP and IFRS. One difference is that under Canadian GAAP, you have the ability to use residual value to value your warrants, or to use Black-Scholes model. And a lot of our clients choose to use the residual value method because it's much simpler. That's where I have a share issuance, a private placement, and I'm issuing it for $1 million. I'm issuing 1 million shares. I've got warrants on them. My shares are valued at $1 each piece, so I've got $1 million in share capital that I got. The warrants are worth $0. That's the residual value method. Some other people will choose to use the Black-Scholes method, and they'll do Black-Scholes calc with the $1 million on top, and then they'll pro-rata the amount of the $1 million they raise between stock-based comp and the actual share capital you raised. So the number that actually ends up in your share capital is never truly what you raised. Under IFRS, they say residual value makes the most sense. You don't value your warrants. Now, let's move on to the next one. We're getting stock-based compensation. Before I had said that there's a change in the way that you're going to calculate stock-based compensation. And now the graded method, I'm not sure if a lot of people are used to graded vesting. Some companies use them. Most of us are doing straight line. So you do your Black-Scholes calc, you've got a vesting period over 4 years, and say you get, make it nice and easy. You got $100,000 Black-Scholes calc vest over 4 years, 25, 25, 25 is what you're going to do. That's straight line. Under graded vesting, every time those options vest is a separate calc. So you're going to say I had 20, say there was 100,000 options. You'd get 25,000 options that would have its own calc in the first year, and you'd have if it was a 5-year life on them, you'd have 5 years, and then 25,000 at 4-year life with the different volatility. So you end up having 4 calcs for that 4-year vesting period, and they're all straight line. They're amortized over the straight line. So what ends up happening is the first year you take in a lot of expense. The second year it's a bit less, but it's much greater than you would have taken in under the straight line method. And in the last year, of course, it drops off. You've got quite a bit less of expense to take in. Now this is a difficult example to go through just by verbally talking about it, but I suggest you talk to your principal or your partner about that, just in terms of how to do the graded vesting calc if you're not sure how it works. Because it is something that it's not difficult if you're already doing your stock-based compensation to catch on how to do it. It's just something you need to get talked through. Non-employee compensation is the next part. Under IFRS, the definition of who is an employee is quite a bit different. So it's broader. So you're able to take a lot more of the people that you've got in consultants. They're going to be employees under IFRS. But when you get to non-employee compensation, the key there is you're supposed to fair value the warrants, or the options that you're giving them. So what's the fair value? The most common area that you're going to run into this is on IR. So you've got an IR person that you're giving 100,000 options to, and if it's in lieu of, say, $3,000 a month, my fee's $8,000, but I'm charging you $5,000 because you're giving me 100,000 options. That $3,000 gap is obviously your fair value. Under IFRS, the preferred method is fair value. So you're supposed to try to get that fair value of what those options are, what that person's giving to you for those options if they're non-employees. If you can't come to a determination as to what the fair value is, then you go and do your Black-Scholes calculation. That's okay. But then it's going to require a bit more disclosure because you have to explain why fair value couldn't be determined in your financial statements. It doesn't need to be incredibly descriptive, but it requires a bit more disclosure on your side to do that. Another unusual part of stock-based compensation is the estimate of forfeitures. Under Canadian GAAP, most of us are treating recording forfeitures as they occur. So somebody gives up their options, then we reduce our stock-based compensation by it if they haven't fully vested. Under IFRS, you're supposed to estimate that up front. So you're supposed to say, I'm giving out 100,000 options. Likely 80% of them are going to go to their term. So I'm only going to value 80% of that stock-based compensation. I'm not going to take 100% of it in. Documenting that is going to be tricky. But as I was talking with a client recently, if you've got your CEO or somebody who's been around in the company for hundreds of years, from being hundreds, a long time, they're going to be there for the next 10 years over the vesting period. You know that. Maybe a director, you've got changing directors, that changes up quite a bit. They might have some forfeitures, so I do it by a case-by-case basis, because in most of our companies, we'll know the 5-10 people who are getting them, and we'll be able to determine who's likely to stay around. If you want to do 100%, if that's the easiest way, then go with it if you feel that that's the reasonable way to interpret it. Let's go on to the next slide. So how do you determine stock-based compensation under IFRS? Again, the methodology to determine fair value is a goods for service received, valuation model, which is Black-Scholes or binomial, or the quoted market price. That's the hierarchy for non-employees and what you should be using. And as the point below, you can use the same fair value calculations that you do in your Canadian GAAP under IFRS. Most people aren't going to use the binomial method. I think only 1.01% of people actually use that method, but it is available under IFRS as well. People are going to stay with Black-Scholes, and that's what we're seeing even in European statements that are coming out out right now. Property, plant, and equipment. Again, this is the section that also applies to mineral properties once you're in development, but it also applies to your actual property, plant, and equipment. What it allows for is revaluations, like I talked about before. With your revaluations, you can do it by an asset basis, your class by class. And if you've got a building and you decide to fair value it, you can annually revalue it, usually by your future cash flows, what you've determined, or the quoted market price. But the problem with that is you're going to need some audit evidence on that, so your costs might increase if you did elect to do that. I mean, if you are in the property business and you've got a lot of property buildings out there, you're going to need somebody to go in and audit a third-party evidence to say, this is my future cash flows off this is my fair value of the property. And so the cost of doing that might not be worth it on your books, because you can discuss it in your MD&A if you've got reliable evidence. Well, at the audit level, we're going to be a bit harder on you guys, so it might not be worth it to do the reevaluation. Most of our clients are definitely going to stick with the cost method. The next point here is if anybody's actually gone out to courses on IFRS, they might have heard about this idea of componentization. And if you haven't heard about it before, I'll go into it. The idea of componentization is if I got a large asset that has many different parts to it, each of those parts break at a quicker rate than the main asset. So we've got a bolt that would break sooner than the large asset. Under IFRS, it says each component needs to be broken out and depreciated at a different rate, but it says each significant component. So there was a lot of worry when they heard about componentization that you'd have to go down to a very detailed level, but it's a significant component. So there is some debate. Some people will say, if I've got a building, my roof is expensive, it has to be depreciated at a different rate. I'm more of the opinion that that building is an asset by itself, and you have to do some repairs and maintenance on your roof. So the componentization worry that you might have heard about previously really is like a lot of things with IFRS. It was it's not as big as people thought it was going to be. It's not a big worry that you guys that's going to affect your statements. Now with your componentization depreciation, your depreciation needs to match the actual useful life of the asset, which is Canadian GAAP. And in reality, the standards between IFRS and Canadian GAAP are very similar. It's just, if you go down to the property, plant, equipment section in depreciation in Canadian GAAP, it says things that are very similar to IFRS. It's just people have dealt with Canadian GAAP for 20, 30 years, 10, whatever the number is. So you're very comfortable with it. You know what the intention of that standard is, so you don't get worried about the words. Well, a lot of people in IFRS are getting tripped up on it because it's presented a little bit differently, but the concepts are the same here. Let's go to the next one. So the related party transactions. This is another area that's going to affect a lot of our clients. Now, I don't know how many of you have actually gone out and looked at statements that are coming out of the European Union, specifically England. Now, Dan had mentioned before that there's conventions. The way that they report their information is different than the way we present our information. So they'll have different names. They'll reverse the order of non-current assets at the top, most liquid assets at the bottom on their balance sheet. One other area this affects is if you go back to related party transactions in a lot of those public statements, they'll say Sir Ian Mackenzie received compensation of $10,000 for his services. That's convention. You don't need to do that. You don't need to name an individual's name and say this person received this much. You're already doing it in your MD&A, where you're listing key management that are their compensation. But under IFRS, you don't need to go into that detail right now, or actually, you don't need to go into it. What they do want you to talk about is what the key management receives. So on a general level, directors received $10,000 in salary, stock-based compensation of X. That's going to be required disclosure. But you can pool them all together. People at a similar level, you can figure out their salaries. Can be a bit tricky in the type of industry we're in. Somebody might wear 5 or 6 different hats, and figuring out what that allocation is. But you are required to give a fair attempt to get that split up done. Another thing is corporate structure. You're going to need to disclose your corporate structure. This isn't a huge point, but it's unusual. If you look at the related party notes and you've got a large consolidated group and you've got 10 subs, under Canadian GAAP you'll have a paragraph that says, this includes the consolidated financial statements of X company, Y company, and Y company. Under IFRS, what you'll generally see, and is the most efficient way to do it, is you'll list your companies in a table. You want to put your ownership interests and the country that they're in. This information is already available, usually in your MD&A, but it's a presentation difference, and it's more just a change as opposed to anything substantial. You've just got to present your information in a little bit of a different way. So now we're moving on to other notable items. The first point, so financial instruments, oil and gas, impairment, asset retirement, obligations, income taxes, and convertible debt. These are items that will affect some of you, but that might not affect all of you. But we felt on the committee that there was enough people that would be in the audience today that would interest some of you, and hopefully we don't bore you with the rest of this. Let's go into financial instruments. So the substance of Canadian GAAP standards essentially converged. That's the point of why we've been having all these changes to our financial instrument standards. Is convergence. There's convergence projects that's gone on by the Canadian Standards Board, and that's why I said at the beginning there's not a lot of significant differences, because you've been dealing with those significant differences between Canadian GAAP and IFRS over the last few years. That's why the handbook's been changing. And again here, there's not a lot of differences. The key differences are reversal of impairment losses and the requirement to disclose the range of fair values for those items which are carried at cost, because fair value is not readily measurable. So if you're carrying something at cost because you can't determine exactly where it is, you have to give out your high and your low end of where that asset can fit on your fair value. And a new standard is expected in 2010 to consolidate this. It'll be IFRS 9. So right now disclosure is IFRS 7, and if I remember correctly, it's IFRS 9 will be assets, and that's coming up in 2010. Next part is oil and gas, and as you can see, it's the same sections as you have for mineral properties. They fall under the same section of the handbook. There's no EIC out there to explain how to treat oil and gas like we have in Canadian GAAP. First point is full cost accounting is currently not accepted in IFRS. There's an exemption to allow you to carry over your full cost pool. So if you say, I've got this big full cost pool and I want to bring it over, take it in my deferred assets, that's okay. But after transition date, your January 1st, 2010, you're going to have to use a successful efforts approach to record your oil and gas assets. So if you're starting up in a company now, keep track of it. I suggest using the successful efforts approach, your policy. And if you've got a company that's using full cost right now, you're going to have that second set of books on your transition date for 2010 to make sure you're tracking your additions under the successful effort method. The next point here is cash generating units. Like componentization, this is a worry in the oil and gas industry. Impairment tests under IFRS are based on cash generating units, the lowest level that you can determine the cash that's coming in. That's what it says in the standard.